We've all seen them, right? Those absolutely terrifying news headlines talking about billions, sometimes trillions of dollars being wiped out from the stock market. It makes you stop and wonder, okay, but where does that money actually go? Does it just vanish? Well, the answer might not be what you think. You're scrolling through the news, and a headline like this just jumps out at you. It sounds like an absolute catastrophe, like a giant vault somewhere just burst open and 100 billion pounds just evaporated. I mean, it's the first question that pops into your head, isn't it? If that much value is just gone, it must have gone somewhere. It can't just disappear. Or can it? The answer, and it's as weird as it is simple, is nowhere. It went absolutely nowhere. And to get our heads around that, we need to completely rethink what we mean by market value. So let's just step away from Wall Street for a minute. Let's go somewhere much more familiar, the grocery aisle. We're going to use a really simple analogy with something we all know, baked beans. Okay, step one. Let's just imagine that every single supermarket in the country, all added together, has exactly 1 million tins of baked beans sitting on their shelves. And step two, the price. Right now, the little sticker on every single one of those tins says £1. Simple enough. So if you do the basic math, 1 million tins times £1 per tin, you get the total theoretical value of the entire baked bean market. And in our little example, that's a nice round 1 million pounds. But then something happens. One of the big supermarket chains decides to have a massive sale to get more customers in the door. And because it's a super competitive market, all the other stores have to follow suit and drop their prices too. Suddenly, just like that, the new price for every single tin of baked beans across the whole country is now just 80 pence. So let's run those numbers again. We still have 1 million tins, right? No tins have vanished. But now their sticker price is only 80p. The total market value has just sunk to 800,000 pounds. So wait a minute, 200,000 pounds of value has just, poof, disappeared from our baked bean market. It was worth 1 million, now it's worth 800,000. So again, where did that 200 grand go? And this right here is the absolute key to the whole thing. That 200,000 pounds didn't go anywhere because it was never real cash to begin with. It was only potential value. That original £1 price was what you could call a hope value. It was the supermarket's hope, their expectation of what you would pay for that tin. Until you actually walk to the checkout and hand over the money, that price is just a number. It's an idea. And this very same principle applies directly to stocks and shares. The only difference is the scale is, well, it's massive, but the basic idea is exactly the same. See, the total value of a stock market isn't a giant swimming pool of cash sitting in a vault. No, it's the collective hope, a massive society-wide guess about what all those shares are worth. It's an educated guess, sure, but it's still just a guess. And this brings up a really crucial distinction, the difference between a paper loss and a real loss. When the market price drops, an investor has a paper loss. Their portfolio is worth less on screen, but they haven't actually lost any cash yet. A real loss only happens the moment you hit sell. So this is the main takeaway. As long as you hold onto your shares, the loss isn't set in stone. Just like the supermarket still has all its tins of beans, you still have all your shares. The hope is that the price, that collective hope value, might just go back up. The real danger, the thing that turns it all sour, is panic. If confidence suddenly shatters, everyone tries to turn that hope value into real cash at the exact same time. This flood of selling just completely overwhelms the few people who are buying, forcing prices down, and that's when potential paper losses turn into huge, very real cash losses for people. And this isn't just theory. This cycle of panic, turning hope into despair, has been the engine behind the biggest market crashes in history, from the Great Crash of 1929 all the way up to the 2008 financial crisis. It's the same human behavior every time. So let's bring it all the way back to that scary headline. That 100 billion pounds, it didn't go anywhere. It was a measure of collective hope, a future expectation, and it was never a giant pile of physical cash. And that hope simply changed. So maybe the best way to think of a market crash isn't as the destruction of money. It's more like a rapid, collective, and often painful, reevaluation of what we all think the future is going to be worth. When you really boil it all down, those huge numbers you see on the news are driven by human psychology. They reflect our collective confidence, our emotions, and our shifting hopes. It's a story about feelings, not just finances. And that leaves us with a pretty fascinating final thought, doesn't it? If the value of our entire financial system is so deeply tied to our collective hopes and fears, what does that say about value itself? What are we truly investing in?